And a couple of reports released yesterday, one from CoreLogic, who do this every month, and also the ASB Housing Confidence Survey, which suggests that things in the housing market aren't getting any better quick. CoreLogic say that in actual fact house values have dropped this year, and that's a permanent drop. I don't know what they mean by it, but they mean that the median price has dropped, and they show that prices have now slipped nationally and it's permanent. So I guess what they're meaning is it's not going to come back in a hurry. I think that's the theory that they've got there. And meanwhile, the ASB Housing Confidence Survey for the 3 months to July showed that people are also not expecting an uptick in prices anytime soon. The ASB senior economist Kim Mundy was quoted as saying yesterday that the gloomy sentiment from most Kiwis regarding house prices is in step with the recent data we've been showing, and house prices falling over the past 3 months. We're seeing a soft housing market, plenty supply, high debt servicing costs, upfront affordability constraints, and also a weakening demand with rising unemployment and easing migration. Joining us to talk about this and what it all means for you, our expert property commentator, usually from the Hawke's Bay. Where is he today? Ashley Church joins us now. Are you in the Hawke's Bay, Ash?
Still in the Hawke's Bay.
I've been looking at house prices in Hawke's Bay, just quietly, and I've been thinking they've come back quite a bit, haven't they, over the last 18 months? I mean,
they've come back and
they've risen quite a bit.
Yeah, they've come back and risen in all sorts of parts of the country, with the exception of Queenstown and a few other locations around the country. Most prices have continued to come back. But interesting, you read those comments from CoreLogic and the ASB, and indeed from other commentators from time to time, because they all have one thing in common, and that is that they're generally wrong. So some interesting things happening at the moment. Firstly, this whole conversation is taking place against the backdrop of the OCR announcement by the Reserve Bank, which came as somewhat as a shock, I have to say. The dropping of the OCR by 0.25 a few weeks ago, I think most commentators expected it to be to stay where it was, but with some sort of soft language from the Reserve Bank indicating that it would come back in the following quarter. And so they caught the market a little bit by surprise. And so you kind of have to take any market sentiment from any surveys that have been conducted by those commentators in the light of that, because those surveys will go back prior to the time of that announcement. So that would have been at a time when people were still expecting interest rates to stay up. Having said that, there's a couple of moving parts to this. One of them is that I have a concern, and I hope I'm wrong, I have a concern that the Reserve Bank may have moved too soon. And what I mean by that is there's a worry that as much as I, as pleased as the next guy that rates are dropping, that by doing this too quickly, that they will have a repeat of what happened in the early 2000s, where they started dropping rates and found that inflation didn't come down, they had to put them up again. So there was a dead cat bounce. I hope that doesn't happen. The reason I fear it is because there's a couple of things that you would expect to take place with inflation that haven't actually happened. The most significant of which is that utility companies, councils and insurance companies haven't been starting to absorb increases in their costs, and they've simply been continuing to pass them on to their consumers. So, for example, councils have continued to put rates up, insurance companies have continued to put premiums up, utility providers have continued to increase their prices. What you would tend to have happen at this point in an inflation cycle is that they would start to absorb that, recognising that their market can't afford them. So the fact that they haven't done that worries me, because it suggests to me that the steam hasn't yet been taken out of inflation. But let's see. Having said all that, big long rant, my expectation is that whether it's now or in 6 months' time, there will be an impact on the market. It will be delayed, and it's delayed for two reasons, Michael. It's delayed partly because confidence takes time. So obviously people have got to start seeing increases in prices before they start being confident to do the same thing themselves. But also, and this one's realer or more real, it actually has to flow through to people's personal circumstances. So you're seeing at the moment that the banks are actually playing silly games with fixed mortgage interest rates, where they're pushing through reductions to their 1 year, 2 year, 3 year and 5 year rates, but they're leaving their 6 month rates stubbornly high. And the reason they're doing that is they're trying to encourage people to take that 1, 2 or 3 year rate rather than the 6 month rate, which means that those rates will stay higher for longer.
Next, everybody is regarding sort of this 2024 in terms of retail, in terms of commercial activity, in terms of business, and I guess in terms of house prices being slightly aberrant, like as in this is a correction. And it's the old story, and Craig Stobo's poo-pooed this, but he said, just survive until 25 and everything will get better. But you're thinking that's probably true of the housing market or not?
Yes, I do. Well, yes, I do. Again, you've got to remember that this market correction, if you want to call it that we've had over the last 2 or 3 years was totally manufactured. And there's no surprise in that. The Reserve Bank did it deliberately. They did the changes that took place to the interest rate environment, the mortgage interest rate environment over the last couple of years were a direct reflection of the mistake that the Reserve Bank made in 2020 and 2021. So that had a knock-on effect with the housing market. This is uncharted territory in the sense that it wasn't part of any cyclic activity that you might normally expect. And so the corollary of that is that if you take that negative stimulus away, that the market recovers. So you would have to expect that's going to happen. It's just a question of how quickly, and that will, as I said before, that will partly be a reflection of confidence, and it will partly be a reflection of people's personal circumstances and paying lower interest rates.
Listen, I'm always meaning to ask you, there's a number of housing or retail sites, or housing retail sites, like homes.co.nz, I think there's TradeMe's got one as well, in which you can search a particular address, most people search their own, and find the market value of your property, or the suggested market value of your property. And I imagine, because it's available, that most people purchasing houses, and I haven't purchased a house recently, since these sites have been going anyhow, actually take them as quite authoritative, and it determines what they're likely to offer a particular place. Is that right? Are they influential?
They are influential. In my view, they're the housing market equivalent of reading chicken entrails. In that they extrapolate those values from a variety of different data, some of which is accurate, i.e. past sales, but some of which is based on some assumptions about what may or may not happen to the market, and some of which is based on a little bit of current market activity, but they're only guesses, and that's why they're all different. If you go to those different sites, you'll find that there could be a difference of, $100,000 or $200,000 in house prices. Yeah, they're quite significant, and in fact, they are no more accurate than council rating valuations, which is a whole other story. I'm pretty cynical about those as well. The only way to know what a property is actually really worth is to sell it, which isn't very helpful to somebody who's looking to put the house on the market and wants to know. So my advice would be do an aggregate of those values, have a look at all of them. There's a number of them. Do some sort of averaging of what they show. That will give you some indication. Take advice from a real estate agent, particularly somebody who's been around for a long time, because they've generally got a good feel for this stuff. But ultimately, you really don't know until somebody snumps up and says, "This is what I'm going to pay."
Yeah. Well, I'm sure that's true, but it's just that. Yes, but does that govern my expectations? Like, for example, let's say I'm a buyer in the market and I go to a particular street. I'll just go to my street, for example, and there's a house there, and I look at all the houses and the value that particular site, like homes.co, for example, .n's got around it, and I go, all right, well, I'd be paying too much money if I was going to pay 1.5. Does it set expectations, though, Ashley?
There is an element of self-fulfilling prophecy in it, in that if there's enough of it going on and there are enough properties sold in a particular area, then to some degree it will influence the market. But again, it's only within the constraints of what's going on in the overall market. So if market confidence lifts, that stuff will become irrelevant. So at the moment, as I say, you'll get a guide, and that guide will be somewhat constrained by what's happened in that particular area over the last 2 or 3 years, and somewhat constrained by the assumptions that the particular profit company has made. But ultimately, if the market turns, all of that stuff will go out the window. It's a dark art in some ways, because there's really no way of absolutely knowing. And if there was, you'd just go to a site and it would say your property's worth this, and that's what it would sell for. Well, that's not what happens.